I will show you how you can replace your full-time paycheck in a couple years and how you can earn tax-free income forever without using a Roth IRA by understanding these tax advantages that the rich keep all for themselves. You can live off passive income forever and choose to do whatever you'd like to do with your time because now you don't have to worry about that 9 to 5. Some people invest in dividend stocks or ETFs alone, and within 20 to 30 years, they can achieve this goal. But I will show you some options of how one could achieve this same goal but in half the time. The big news here is that you could retire early and tax-free without having to use a Roth IRA to achieve this goal. This is not your only option though, and this is what's never talked about here on YouTube. When it comes to dividend versus growth investing, many people just ask me, why can't I just invest in the growth funds or growth stocks, make a whole bunch of money, and then take that money and put it into dividends at that point that I actually want to live off the dividends? So I'm going to show you the actual data, and I've done the research for you so you can make the best decision for you and your investing needs. I'll also include all the info needed for dividend taxes and capital gains tax in general, because without understanding that, none of this will work. You can live off passive income much earlier than you think when you understand the tax code and the advantages to being a long-term investor. I'm Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. So I'm going to show you some examples from the 3 categories of ETFs that I go over all the time, which are dividend, foundational, and growth, so that you can see the data yourself. Each of these will be comparing apples to apples as if you invested $50,000 10 years ago. And the first one up on the list is the dividend ETF. SCHD is my favorite, but a couple other good ones are VYM, FDVV, DGRO, and VIG. SCHD has had an average appreciation with dividends invested at 12.84% since 2011, so almost 20 years. But let's take the smaller number to be safe and go off the past 10-year return, which is 10.84%. $50,000 invested and putting in $200 per month for 10 years at 10.84% per year comes out to $179,762. Not bad. For the next category, this would be your foundational category, one that's covering the entire US stock market, something like VTI, or the top 500 companies in the United States like the S&P 500 or VOO. Out of these two, I picked VOO, but their returns are almost identical. Since inception, VOO has beaten SCHD and has an average rate of return with dividends invested each year at 14.51%. Let's take the smaller number here to be safe again and go with what has happened over the last 10 years, which is 13.11%. $50,000 invested and putting in $200 per month for 10 years at 13.11% per year comes out to $215,831. Even better. Last is the growth category, and this one's probably everybody's favorite, and there's a lot of heavy hitters here, like VGT, SMH, SCHG, FTEC, VUG, and QQQM. For broad growth that's a bit less risky, my 2 favorites are QQQM and SCHG. For the data here, I'm going to use QQQ, which is the fund that QQQM is modeled after. They're literally almost identical and from the same company with the same holdings, but QQQM has an expense of 0.15%, where QQQ has an expense of 0.20%. QQQ just has more history since it was built first, so I'm using that data. QQQ has a 10-year average yearly appreciation of 18.33%, so when we plug that into the calculator, $50,000 invested and putting in $200 per month for 10 years at 18.33% per year comes out to $326,478, almost double that of the first one. What we care about most, though, is the dividend or living off of passive income. And so we're going to look at SCHD's dividend yield. SCHD's dividend yield is 3.52%. So with $179,762 in SCHD, you could expect about $6,327 in dividends each year. If you went with option number 2 and then after 10 years moved that money from VOO to SCHD, you would have $215,831 total and could expect about $7,597 per year in dividends. With the growth fund and your total at $326,478, and you then move that to SCHD, you could expect dividends of $11,492 per year. Dividends are just so powerful, and when done right, they're an absolute hack to an amazing, peaceful life. But as you'll see in this video, and as you research a little bit deeper into the category, you'll see that it's a little bit tough and a little bit complicated to invest in dividends correctly. I wanted to make a resource for you that I wish that I had 10 years ago when I was starting my investing journey. This is the best 17 short videos on everything you need to know to go from being a beginner or intermediate dividend investor to being advanced and on your way to passive income for life. It's on sale now and has received glowing reviews from over 200 people so far. The link is down in the description below, so check that out as soon as possible. But now looking at the screen and seeing one clear winner, most will say, why not just invest in the one that gets you the most and be done with it? Well, yes, honestly, that would be the best way to go. If we knew which one was going to be the clear winner every single year, forever. In 2022, QQQ went down a whopping 32.58% in 1 year, whereas SCHD only dropped a minimal 3%. The ones that can go up the most are also the ones that can drop the most. And this is the genius of my 3-fund portfolio. Investing in all 3 makes it so that you can get those big gains from the growth category, but also minimize the losses by investing in something stable like SCHD for value or dividends. So understanding all of that was probably a lot, but the most important thing is actually this next piece, which is the tax implications of your decision. Now, if you're investing purely in a retirement account or a Roth IRA, then you wouldn't have to worry about taxes or even have to figure that out right now or weigh the options, because within the retirement account, you're not being taxed. But the whole point of this thing is to retire early or before age 59 and a half. So if you want to do that, you have to be investing within a brokerage account as well. So if you would have chosen to invest in SCHD during that time, you have 2 options. No matter what, you're going to be charged taxes every time that you receive a dividend, even if that dividend is being reinvested directly back into the fund. So even if you're not ever using the dividend, it's just snowballing right back in, you still will be taxed at the end of the year. So your first option for those taxes is to just set some money aside, knowing that you're going to have to pay taxes at the end of the year based off the dividends that you've incurred. As a quick example, if you had $100,000 in SCHD, the capital gains tax will likely be 15% if you live in the United States, and since you'd still have a job, since you aren't living off the dividends yet. So on $100,000 invested in SCHD, you'd pay a yearly tax of $487, not too crazy. Your second option is more for if you had something way higher than just $100,000 invested in SCHD and your tax bill was much, much bigger. If it was something like $5,000, $10,000, $15,000 per year, you might want to go ahead and just sell off a couple of shares in order to offset that payment. So you sell the shares in order to pay the taxes. That's the way that some people do that. Obviously, the tax drag becomes real the more that that account grows, but the one thing that you don't have to worry about is paying a humongous tax bill like you would have to do if you went with option number 2 or number 3 from what we talked about before. In the next 2 options from before, using the S&P 500 or QQQM, you'll need to sell your shares in order to transfer it to SCHD at that point, if your plan was to grow it as much as possible and then move it over to dividends. So if you had that $326,000 from before and wanted to move it to SCHD to then get dividends forever, and when you do that, you're going to incur a huge tax bill on those gains that you made from QQQM over that time period. For example, if you had put in about $74,000 and it had grown to that $326,000, you'll be taxed on that $252,000 that you gained, which is a big tax bill at that time. This is not your only option though, and this is what's never talked about here on YouTube. Capital gains tax works the same with dividends as it does when you sell the shares of the actual asset. So again, from the figure showing capital gains tax, it shows that you're taxed 0% up to $47,025 if you're single, and 0% up to $94,050 if you're married. So let's say you're single and you want to retire completely, having no other paycheck come in and live just directly off of only your investments. And let's say you have over $1 million in VU at this point. You figure you need about $5,000 a month or $60,000 a year to live comfortably. Currently in California, you need to be making a salary of $83,000 so that after taxes you actually see $60,000. Let's say you've been investing in VU for 10 years and over that time period it's gone up 100%. So if you take out $60,000, you can likely assume that you put in about $30,000 of that and it grew another $30,000 because that would be 100% growth. So $30,000 of that $60,000 is capital gains. But look at the tax rates again. You get up to $47,025 of capital gains before you would need to pay a tax. So you could literally sell $60,000 worth out of your account from VU and not have to pay $1 in taxes at all. And this is within a taxable brokerage, not a Roth IRA. So you could basically achieve the same thing we're looking for from dividends, but this time it's through an asset that isn't producing dividends, or at least as large of dividends. You're just selling the shares and getting capital gains in that regard. And by doing it this way, you don't have to sell out of that huge position within VU and move it all over to schd, because if you did that, then you would incur taxes because now you're over that threshold. The con of this strategy, of course, is that you're actually selling shares of that asset though. For dividends, the beauty is that you never actually have to sell any of your shares in theory. You could just live off the dividends. Once that thing has grown big enough, now it's spitting out a dividend every quarter. And so you're just living off the dividend part, and the shares within schd can continue to grow, and you'll just have that huge amount of money that's just sitting there, never have to pull from. You could give that over to loved ones later on, or you could give it to charity. It's just such an awesome way to invest, and that's why dividends are so powerful. For the VU or QQQM option, say you had like 10,000 shares and you needed to live off of 500 of them. This year you have 10,000. When you sell 500, next year you're going to have 9,500. Then the next year you'll have 9,000. It's just a finite amount of shares, and that could get a little bit scary, especially as you're in retirement and you kind of want to make sure that this thing's around for the rest of your life. Whichever strategy you want to use is up to you, but the big news here is that you could retire early and tax-free without having to use a Roth IRA to achieve this goal. If you're a couple and you need $100,000 to live comfortably, you could pull that out easily and not have to pay 1 cent in taxes if we use the example from before. A couple where I live in California would have needed to be bringing in $152,000 per year from their jobs to achieve this. But with investing, the rich get richer and pay way less in taxes, so $100,000 in this case would be able to be taken out completely tax-free. The main point that I wanted to make with this video is that there's more than one way to skin the cat. I love to present my clients that I work with in my private financial coaching with a bunch of different options because each person is different and different types of options work for different people's goals. You can live off passive income much earlier than you think when you understand the tax code and the advantages of being a long-term investor. Keep it simple and stay on course. To learn more about how I invest as a hybrid between all of these different types of categories, watch this video now or watch this video to keep you going strong in your investing journey.